FA2 Key Terms Part B and C. Part B. Advanced Accounting Procedures. Chapter 5. Accounting Concepts and Principles. Basic Accounting Principles and Concepts. Basic accounting principles and concept are the broad assumptions which underline the periodic financial accounts of business entities. Business entity concept. The business entity concept, a business, for accounting purposes, is a separate entity from its owners or managers. We looked at this in Chapter 1. Double entry bookkeeping. Double entry bookkeeping, introduced in Chapter 1 and covered in detail in Chapter 4, is the system of accounting which reflects the fact that every financial transaction affects the entity in two ways and gives rise to two accounting entries, one a debit and the other a credit. The total value of debit entries is therefore always equal at any time to the total value of credit entries. Going concern. The going concern assumption implies that the business will continue in operation for the foreseeable future, and that there is no intention to put the company into liquidation or to make drastic cutbacks to the scale of operations. The money measurement concept. The money measurement concept states, accounts only deal with items to which a monetary value can be attributed. The separate valuation principle. The separate valuation principle states, each component part of an asset or liability on the statement of financial position must be valued separately. Accruals. The accruals basis requires that the impacts of transactions and other events are recognized when they occur, and not as cash is received or paid. Transactions should be recorded in the accounting records and reported in the period to which they relate. Expenses are recognized in the income statement on the basis of a direct association between costs incurred and the earning of specific items from income. The expenditure incurred in earning the profit for an accounting period is matched to that profit. For this reason the accruals basis is sometimes referred to as the matching concept. Prudence. Prudence states the inclusion of a degree of caution in the exercise of the judgments needed in making the estimates required under conditions of uncertainty, such that assets or income are not overstated and liabilities or expenses are not understated. Consistency. Consistency requires that similar items should be accorded similar accounting treatment. Materiality concept. Under the materiality concept, only material items should appear in the financial statements. Items are material if their omission would influence the economic decisions of users based on the financial statements. Historical cost. Using historical cost has a number of implications. Transactions are stated at their value when they occurred. This means, for example, that the cost of goods sold is not suddenly increased at the end of the year. Assets are stated at their historical cost. In other words, the value of an asset in a statement of financial position is based on the price that was paid for it. Accounting policies. Accounting policies are the specific principles, bases, conventions, rules and practices adopted by an entity in preparing and presenting financial statements. Chapter 6. Control accounts and the correction of errors. Control account. A control account is an account in the general ledger in which a record is kept of the total value of a number of similar but individual items. Control accounts are used chiefly for trade receivables and payables. Receivable ledger control account. A receivable ledger control account, also known as the receivables account and sometimes called a sales ledger control account or debtors control account, is an account in which records are kept of transactions involving all receivables in total. The balance on the receivables control account at any time will be the total amount due to the business at that time from its customers. Payables ledger control account. A payables ledger control account, also known as the payables account and sometimes called a purchase ledger control account or creditors control account, is an account in which records are kept of transactions involving all payables in total, and the balance on this account at any time will be the total amount owed by the business at that time to its suppliers. Contra. If two businesses owe money to each other, they might agree to set one amount off against the other. This type of transaction is known as a contra. An error of transposition. An error of transposition is when two digits in an amount are accidentally recorded the wrong way round. For example, entering 47 instead of 74. Error of omission. An error of omission means failing to record a transaction at all, complete omission, or making a debit or credit entry, but not the corresponding double entry, error of partial omission. Error of principle. An error of principle involves making a double entry in the belief that the transaction is being entered in the correct accounts, but subsequently finding out that the accounting entry breaks the rules of an accounting principle or concept. Errors of commission. Errors of commission are when the bookkeeper makes a mistake in carrying out his or her task of recording transactions in the accounts. Compensating errors. Compensating errors are errors which are, coincidentally, equal and opposite to one another. Error of original entry. An error of original entry means that the transaction was incorrectly recorded in a day book, leading to incorrect ledger postings. Error of reversal. An error of reversal occurs when the debit and credit postings are reversed. Suspense account. A suspense account is an account showing a balance equal to the difference in a trial balance. Bank reconciliation. A bank reconciliation is a comparison of a bank statement with the bank account in the general ledger. Differences between the balance on the bank statement and the balance in the ledger account will be errors or timing differences, and they should be identified and satisfactorily explained. Chapter 7. Accruals and prepayments, receivables and irrecoverable debts. Accruals. Accruals, or accrued expenses, are expenses charged against profits which relate to, i.e. have been incurred during, a particular accounting period, even though they have not yet been paid. Prepayments. Prepayments are payments which have been made in one accounting period, but should not be wholly or partly charged against profit until a later period, because they relate to that later period. Receivable. A receivable is a balance owing to the business. Trade receivable. A trade receivable is a balance arising in the course of normal trading operations, when a customer buys goods without paying cash for them straight away and who therefore owes money to the business. Irrecoverable debt. An irrecoverable debt is a specific debt which is not expected to be repaid. Allowance for receivables. An allowance for receivables is a general estimate of the percentage of debts which are not expected to be repaid. It is based on past experience. Current assets. Current assets are items owned by the business with the intention of turning them into cash within 1 year, inventories of goods, and receivables. Cash, including money in the bank, owned by the business. Assets are current in the sense that they are continually flowing through the business. Current liabilities. Current liabilities are debts of the business that must be paid within a fairly short period of time, by convention, within 1 year. Provision. A provision is a liability of uncertain timing or amount. Liability. A liability is an obligation of an entity to transfer economic benefits as a result of past transactions or events. Chapter 8. Cost of goods sold and the treatment of inventories. Carriage. Carriage refers to the cost of transporting purchased goods from the supplier to the premises of the business which has bought them. Someone has to pay for these delivery costs, sometimes the supplier pays, and sometimes the purchaser pays. Net realizable value. Net realizable value of inventory is the selling price less any costs still to be incurred in getting the inventory ready to sell and selling it. FIFO, first in, first out. FIFO, first in, first out. Using this technique, we assume that components are used in the order in which they are received from suppliers. The components issued are deemed to have formed part of the oldest consignment still unused and are costed accordingly. Weighted average cost. Weighted average cost. As purchase prices change with each new consignment, the average price of components in the bin is constantly changed. Each component in the bin at any moment is assumed to have been purchased at the average price of all components in the bin at that moment. The weighted average cost can be applied as continuous or periodic. Chapter 9. Non-current assets and depreciation. Non-current asset. A non-current asset is one which is acquired and retained in the business with a view to earning profits and not merely being turned into cash. It is normally used over more than one accounting period. Capital expenditure. Capital expenditure is expenditure which results in the acquisition of non-current assets, or an improvement in their earning capacity. Capital expenditure on non-current assets results in the appearance of a non-current asset in the statement of financial position of the business. Capital expenditure is not charged as an expense in the income statement. Revenue expenditure. Revenue expenditure is expenditure which is incurred for the purpose of the trade of the business, including expenditure classified as selling and distribution expenses, administration expenses and finance charges. To maintain the existing earned capacity of non-current assets, for example repairs to non-current assets. Capital income. Capital income is the proceed from the sale of non-trading assets, i.e. proceeds from the sale of non-current assets. The profits, or losses, from the sale of non-current assets are included in the income statement of a business, for the accounting period in which the sale takes place. Revenue income. Revenue income is income derived from the sale of trading assets, such as goods bought or made for resale. Rent, interest and dividends received from non-current assets held by the business. Revenue income appears in the income statement. Depreciation. Depreciation is the allocation of the depreciable amount of an asset over its estimated useful life. Depreciation for the accounting period is charged to net profit or loss for the period, either directly or indirectly. Depreciable assets. Depreciable assets are assets which are expected to be used during more than one accounting period, have a limited useful life, and are held by an entity for use in the production or supply of goods and service, for rental to others, or for administrative purposes. Useful life. Useful life is either the period over which a depreciable asset is expected to be used by the entity, or the number of production or similar units expected to be obtained from the asset by the entity. Non-current assets register. A non-current assets register is a listing of all non-current assets owned by the organization, broken down perhaps by department, location or assets type. Chapter 11. Extended trial balance. Extended trial balance. An extended trial balance is a worksheet, used to keep track of adjustments between the trial balance and the final accounts. Part C. Incomplete records and other accounts. Chapter 12. Incomplete records. Markup. Markup is the gross profit as a percentage of cost. Gross profit margin. Gross profit margin is the gross profit as a percentage of sales. Chapter 13. Partnerships. Partnership. A partnership can be defined as the relationship which exists between persons carrying on a business in common, with a view of profit.